The Rebel Capitalist Show. The gold price going down right now. You explained it really well with the margin call, but I don't know that everyone understands how that process works. So can you just quickly explain that? And then I'd like to get your thoughts on not only the dividend paying stocks outside the United States, but also the silver to gold ratio and why that's important.
Yeah, well, first of all, the price of gold is around, what, 1,500 and change right now, 1,530, 1,550-ish. This most recent bull move started really in January of 2016 with gold just above 1,000. And we peaked out at 1,700 early in this crisis. So we had almost a 70% move, 65% move up in the price of gold. And then we had about a 10% correction as markets started to implode. But, the stock market went down 30%. The small caps down 40%. So gold went down less than stocks. So people who were in gold, preserved a lot more purchasing power than people who were in riskier assets. But you mentioned silver. I mean, silver is at an all-time record low. You could buy more than 100 ounces of gold with silver. That's never happened before. So gold is gaining value relative to commodities, relative to financial assets. But yes, there was a rush to sell some gold recently. I think people needed money and they had to get it wherever they could. They had margin calls that they had to meet, not necessarily on gold, on other assets. And to meet it, they had to sell gold. They couldn't meet the calls with gold. They had to get dollars. And so I think there was some selling in that market. But, it wasn't, dramatic. And I think we might have already seen the lows in gold. And I think we're headed back up. I mean, just because it goes down for a few days doesn't mean it's not a long-term store of value or a long-term safe haven. Sure, anything can fluctuate in value on any given day, depending on the market. But I think gold is going much, much higher in terms of stocks. Gold is only down about 2% this year, whereas stocks down, 25, 30%. And I think by the end of the year, gold is going to finish much higher. I don't expect the U.S. stock market to recover these losses. It's going to have a down year for 2020. So, gold investors are doing much better. In fact, if you go back to the beginning of this century, year 2000, gold was under 300. The Dow was around, 10, 11,000. So the Dow was roughly doubled based on where it is now, and the price of gold is up fivefold. Yeah. So even with the dividends on the Dow, it doesn't compete with just owning an ounce of gold and keeping it in a shoebox. And I think that's going to continue. I think you're going to see gold continuing to gain value. Gold stocks, highly speculative. Gold stocks got clobbered more than non-gold stocks. I think, again, it's a less liquid market. So if you get a bunch of sell orders coming in, it's going to have a bigger effect on the way down. But, of course, it has an even bigger effect on the way up. Look over the last 2 days. We've seen some of these gold stocks up 40, 50% off their lows in 2 days. So you have extreme volatility in these assets. If you can stomach the volatility, I think a lot of these stocks are going to go up 10 times, 20 times, 50 times over the course of the next 5 or 10 years as this bull market really gathers strength and as we go to this inflationary environment.
I'm guessing I already know your position on gold, but let's hear it. Let's hear it right from Lynn Alden herself.
Yeah, I'm bullish on gold and silver for the long term. If we see a brief, dollar spike upward, we still could get more pressure on them in the near term. But I definitely consider them important holdings for the long term. I started adding them to my portfolio in 2008. I've actually been investing in precious metals since the late 1990s. But I originally sold my collection back in 2011. And then it's been since 2018 that I've been buying back pretty sizable physical positions, in addition to miners, royalty companies, and other ways of getting exposure.
So you bought at the absolute low, or maybe at the absolute low. You sold at the absolute peak, and then now you're starting to buy again. And we'll see where it goes from here.
Part of my sale was luck. It was like there's so much positive sentiment, and so I unloaded my position back then. And then in this recent turn, I didn't buy it. The low was back in 2015, 2016. So I missed the very low, but the actual, if you look at the gold to S&P 500 ratio, the low for like S&P 500 price in gold, that actually bottomed in 2018 and started turning up. So I managed to kind of catch that low, but not the actual absolute low.
How would you suggest the average person out there position themselves in gold now?
So the average person, to apply what I just said to their portfolio, I would say two things. For me, I just like owning gold bullion coins, miners, royalty companies. I think the majority of my gold ownership is in physical bullion coins because it just takes away the risk of operational execution.
Just buy it with the intent of just keeping it forever.
Yeah, because I think in addition to being insurance, I think it is going to be repriced one time. I think it is effectively going back into the system. It's going to be need to be made much bigger relative to global trade to serve a role as some sort of neutral asset. I think that will happen one time, and then I'll figure out what I want to do with it from there. In terms of what to do with the possibility that because of the structure of the gold market that you could get this paper sell-off, if I owned it, I would want to scale my position to my understanding that that's a possibility, so that if it does happen again, like it happened in 2013, you don't get shaken out of it. You're not so big that you get shaken out of it, and that you just understand, okay, there's this run happening and I can see it happening, and it might not feel good, but if you're sitting there so big that you're doing your net worth calculations and you're taking food off your table, well, that's not helping you.
Right.
But if you understand that, hey, this could happen, and if it does, I have dry powder, I'll just buy more. Just understanding that the market is structured in that way, that it just gives you some level of comfort. So when you're watching things happen, right? I mean, we saw it a little bit in March. I mean, there was mostly just people selling, paper future contracts when you sell what you can, not what you want to. And so we saw in the early stages of the crisis in March, gold sold off with equities pretty sharply. But if you looked at some of the underlying dynamics, and Roy Sabag over at Gold Money highlighted some of those, and some of the spreads between New York and London, the underlying dynamics were suggesting people are still flocking to gold. It's just this dynamic of paper selling and has nothing to do with what's happening to the physical. And so I think that's just important to understand, particularly as people are getting more involved with the gold market, I think, given everything else that's going on around us.